Hey guys, Shoop here. Welcome to my latest edition of Bank It or Tank It. Today it's going to be a little different. We're going to be focusing on the S&P 500 index once again, but this time it's basically going to be a stock market update because of all the volatility that we've seen, everything that's been going on in the stock market. I want to use today to basically update you on how I'm trading this market, what it means going forward, where I see the stocks bottoming, and how we're basically just going to trade this over the next few months for the S&P 500. So before I dive into my S&P 500 Bank It or Tank It today, I just want to give you a chance to go right below this video, click subscribe so that way you don't miss out on any of my new videos. Next week I have a brand new Bank It or Tank It, and if you're not following me on Twitter, be sure to check it out at Shoop. Guru is my Twitter handle, and on there I've been posting a lot of quick takes and a lot of insights just along the way throughout this volatility, letting you know. Even on last Friday before we went into the long weekend, I said this is not a dip I wanted to buy, and then look, futures tanked on Sunday night. I just felt like it's going lower based on some of the technical indicators that you can see on the price chart coming up, and just the overall feeling after the Fed cut rates, which I'm about to explain. This was a bearish situation, so just check me out on Twitter. I'm keeping little updates along the way. You can follow me and let me know what you're banking or what you're tanking or just how you're adapting to this volatility. But just check me out on Twitter and follow me there. And always be sure to leave me a comment. You can leave me a comment below this video, or you can go to Twitter, leave me a comment, just make sure you mention me, or you can use the hashtags Bank It or Tank It. But basically, I want to know what stocks you want me to take a look at. In a few weeks, we'll hold a Twitter poll to figure out which companies are you all most interested in for me to cover. But for now, just leave me a comment. I'm adding them to a list, and I also like to use them as my quick take stocks throughout the week on Twitter. So just go to Twitter, you go to the comments below this video, and just let me know what stock you want me to take a look at. So with the S&P 500 today, there's been a lot going on, a lot of volatility, and I want to walk you through basically how we're trading it, how we're going to continue to profit during this volatile market. Now, in my analysis today, we're not going to be featuring the fundamentals, the sentiment, because let's be honest, everything that's going on with the stock market right now is really not about the fundamentals and sentiment, because all of that data is backwards looking. When we look at the key statistics for the GDP, the corporate earnings announcements, or jobs data, any other data that we can really get is all about what's already happened when the stocks are actually reacting to what they see in the future. So that's a lot of the reason that we're just going to talk today about what we're seeing in the S&P 500, and then we're going to take a look at the price chart, because that's telling me the key levels to watch, and really it'll explain why I'm looking at the S&P 500 the way that I am. And when we talk about the market today, I just want to take you through my thought process, because if you follow me on Twitter or in my premium services, a lot has changed over the last 2 weeks. Now, 2 weeks ago is when the stocks really started to crash. We saw the 10% correction within 1 week of the stock market from the all-time highs. Over the next 5 trading days, stocks just got hammered and hammered and hammered. Then on Monday, we saw a bit of a rebound. Everybody was expecting to see that V bottom, where it's just a sharp turn higher. And then Tuesday had a little bit of the continuation. This was last week, Monday and Tuesday. But then the Federal Reserve Act, they had an emergency interest rate cut, and that sparked panic in the stock market, because the Fed panicked. And on Twitter, before stock market even reacted, I posted a tweet just letting people know that I thought things were going to get a lot worse from here, because the Fed was panicking about something, and they just got off a meeting with the G7 countries, and something that was said on there really caused alarm, and they understood that there's global economy was going to be suffering, and the U.S. was facing recessionary pressures, and they wanted to act, and they wanted to act fast. But that was probably the wrong move, because they had a meeting coming up in just 2 weeks that they could have really telegraphed and kept the market at ease and still cut interest rates then. So the fact that they felt they had to do it 2 weeks before the next meeting means that they really saw a sense of urgency, and there's something far, far greater here going on other than just a few quarantines for the coronavirus. They see things getting a lot worse, and the global economy is taking a massive hit. So when that happened, I had a shift in my mindset, and I immediately went from wanting to buy the dip to now it's going to be a trader's market. We're going to be in here taking short-term profits. On that day that the Fed cut interest rates, is actually, I wrote out a few alerts where we were taking profits or cutting small losses on many of our long positions. We still held some, because I still expect stocks to see a rebound, and I'll talk to you more about that when we look at the chart. But more importantly, we added on 2 put options on retail trades that handed us quick 50% gains on half of those trades, and then got out a little bit less than that on the second half. So we were able to see a quick bounce, take some profits. We also added an inverse energy trade for one of my seasonality services. So that was great to see too. Handed us some quick gains. So it's just about being nimble here through the volatility in the stock market, because before, when we were down 10% from all-time highs in 1 week, I expected to see a nice rebound. It was just a healthy correction for stocks. They had the coronavirus to really just pin the blame on. But now with the Fed acting, this coronavirus is a lot more than a correction. And my mindset went from just a quick correction to stocks rallying to this could be the next big stock market crash. And I'm not the type to really throw that out there a lot, to call that we are on the cusp of a recession. Maybe we're already at the beginning of it, and that it's all going to be caused by the coronavirus because of the way we're handling the quarantining. People are just flat out afraid to travel, and it's not because they're afraid of having contact with the virus. It's because they don't want to be quarantined. I know me, my family, my kids, I don't want to be quarantined on a cruise ship for 14 days with a bunch of people and not being able to use the amenities on the ship, or quarantine at some naval or army base somewhere in the country for 2 weeks there. I mean, it creates a nightmare situation. So people are doing what they would normally do in a recession because of financial woes. Just now they're doing it because of their fears over a coronavirus. They're moving vacations. They're not going to concerts. They're avoiding large crowds. They're not going out to eat as much. They're avoiding the gym. They're cutting back on all these things that you typically see people cut back on during recessionary times. But they're doing it even though the consumer is extremely healthy and has extra money to spend and is willing to spend it. They just are afraid of this virus and the way that we're reacting to it, because the Fed, they cut interest rates, and that was great, and it would increase lending, and it's a stimulus. But go back to the global financial recession in 2007 through 2009. The Fed was cutting rates in 2007 there too. So it doesn't mean that there's a short-term bottom here, but what it means is that they see something a lot bigger going on than just a quick correction for the stock market. They think that we're on the verge of a next big crash, and they're acting aggressively. But to me, that just justifies that there is this major slowdown going on a global scale. And as we see more people continue to reduce spending, push vacations out farther, we're going to see it take a big toll on the US economy as well. So over the last 2 weeks, my mindset has totally shifted from buying the dip to now we're in a trader's market. It's going to be a bunch of volatility, and we could be on the cusp. And I don't say this to scare you, just to be prepared of the next 50% crash for the stock market. And if that alarms you, then take a look at the price chart today when we run through the S&P 500 analysis, because on there we'll be able to highlight several of these key areas for you to take a look at if you're interested in trying to buy the dips, or if you're looking to benefit from further pullbacks. Because that's the great thing about the stock market nowadays. Retail individual investors just like you and me, we have the ability to buy put options, to buy inverse ETFs, to do these different strategies to take advantage of pullbacks. So it's really not that big of a deal. You know, if you're in this for buying and holding stocks for even the next 5 to 10 years, if that's your timeline, then you don't want to get caught up in trying to close out positions and then buy back in at a lower price, because the whipsaw volatility in here is really where you get stuck, because you sell now after the stocks have sold off by 15%, but then we're going to go through a nice rebound, maybe 7, 8, 10, maybe even 15% to 20% rebound, get us back near the all-time highs for the stock market. That's when everybody else comes back in. You sell at the lows, you see the rebound, you buy at the highs, and then it rolls over again and another big crash, and you're having to take losses once again. So if you're a long-term investor, you just need to stay invested. If you're a shorter term, trading a few months at a time, that's where we're going to be nimble. We're just going to shorter our profit-taking opportunities to, even if it's just a few days, we're just looking to come in, scoop up some profits and move on. And if you're a day trader, then this doesn't bother you at all. You actually love the volatility, and you're just in there having a blast, trading all these whipsaws back and forth, trying to make a little bit of money. So before we jump into the price chart for the S&P 500, just wanted to run through a few more of the stats that really help build up the mindset of me being more bearish at this time than I really have been over the last several years because of the coronavirus. Now, we had oil prices plunging also down 30% in the futures on Sunday night. So that was a massive move. And that means lower oil prices for you and me, the consumers, which is great. But again, we're not the issue right now. The consumer is healthy. If we have extra capital to spend, that's great. But we're planning trips a year and a half away from today because of the fears over the travel restrictions and everything going on for the virus. So that's really not going to be a short-term stimulus. It's going to be longer term, and it's great, but it's not going to happen right now. So this could be a unique recession where the consumer doesn't really feel like we're in a recession because we're spending like normal. We're just not taking vacations and doing some of these other things because of the virus, but it's not because we don't have the funds. So it's a unique recessionary environment if we get that deep into it to actually call it a recession, but it's going to be a unique contraction for the US economy where the consumer feels extremely healthy. But again, the oil prices, even though it's good for the consumer, it's very bad for oil stocks. These energy sectors are going to just get clobbered over the next several weeks due to this. It's going to take them even longer to recover. So that's going to be a negative for the stock market. But when you look at these other stats that are out there, we had the trade wars that were implemented about 2 years ago. Those were bearish for the global economy. Trade wars are short-term stimulus. As you cut trade, American producers can produce more, but then as you open it back up, you got the higher prices for the American producers. That isn't sustainable, and they have to go through layoffs, and it ends up being a negative drag on the economy despite the short-term boost. But we had the tax cuts to really help offset that, and then the Fed was raising interest rates along the way. So we've really never been in an environment where we've had trade wars, rising interest rates, and inverted yield curves. All these are recessionary indicators. When these things happen, a recession tends to follow. It's just how far away until we hit the recession. It's the timeline that people really debate. But the idea that within just a few years of either seeing tariffs, trade wars, inverted yield curves, rising interest rates, at some point over the next few years, a recession comes along and hits the U.S. economy. And that's where we're setting up today. We have the coronavirus, which, again, the virus itself is not that bad, but just the fear of being quarantined has people afraid to book vacations, afraid to travel, and that's going to contract the U.S. economy. Having schools closed, having parents have to stay home, working from home to take care of their kids, it's a different situation. And we're going to see the U.S. economy contract over the next several months. So again, I say all this not to alarm you. We're in a global slowdown, but the way to trade this, if you're long term, you don't have to worry about it. You just stay bullish. Stay in the stocks because they're going to rebound at some point. And if you're more shorter term like me, trading a few months at a time, we're going to find opportunities in this to continue to make money. Just take shorter term gains, cut losses, and move on and look to free up any long positions that you have on the next bounce in the stock market. So let's dive into the price chart now, and we'll take a look at some of these key levels to keep an eye on, so that way you know what to expect from the S&P 500 over the next few months and during this volatility. Now here's our price chart on the S&P 500, and you can see we still have the same levels that we were looking at before: the red resistance line, the green support, and the yellow 200-day moving average. Now the 200-day moving average was typically a sentiment indicator, but you can see right now price is below it, so that's kind of a mixed sentiment reading. The average was moving higher, but you can't really see it on this chart, but it's starting to move lower. You can see it started to flatten out there if I move the support out of the way, but it's starting to turn lower, which will be a bearish sentiment indicator because price is below the 200-day moving average, and then it's about to be heading lower after the sharp correction that we've seen. But part of the reason that I've turned bearish for the stock market also is because it broke back below this red resistance line that was in place for over a year and a half, and it was a key level to watch. We had the breakout from it. It was textbook. The price even moved the expected move that I laid out for at the beginning of the year. This was my green line, just indicating that's when we had our bank it or tank it on the S&P 500, and we called for prices to shoot up to 3,400, and they did. So we saw that play out as expected, but the pullback, the crash, was just way sharper than we would have liked. And then prices broke back below that red resistance line. So that was not great to see. And then they tried to climb back above it. You can see a couple days here where the little candlestick gets above that red resistance, which would have been bullish. We would have been very nice to see prices close back above that and hold and just start to trend from there. That would have been a sign that this correction was really not that big of a deal. But we didn't see that happen. Instead, prices broke back below that and have tumbled since then. So now we have a few other key levels to watch. This is the first one in dotted lines. So everything I've added today are in dotted lines. So this is a green support, just going off the lows of this pullback that we've seen. It would be fantastic to see that hold. In fact, the only real way for me to remain bullish over the short term is if this support holds, because as you can see, if prices break below that support, this is my next level of support. It's way down here, 2,500 on the S&P 500. So it's not looking pretty if we close below that. Again, we could keep drawing new support lines all the way through here, but this support, as I zoom out, you'll see that this is a pretty solid support area, going back to the low here in 2018, but then even going back to the pullback in 2016, the lows there, and then it touches in 2011. and we can extend it down to even 2009. So this is the ultimate uptrend for the stock market right now. And it pains me to say this, that still is stocks could fall to 2,600 and still be in an uptrend, but that's the reality. Prices have basically not gone anywhere over the last 2 years or so. You can go back to 2018, and after the pullbacks that we've seen lately, that's where the stocks are trading. Over 2 years since we've seen stocks trading at this level. So prices have essentially been consolidating. And when we zoom in, I just want to talk about different types of tops. What we saw here was called a blow off rally. We see the massive run higher. It was a quick short term gain that was higher than many people would have expected. And then we had the quick crash. So this isn't as telegraphed as it was back in 2007 and 2008, which basically had a rounding top. But that actually came up at a retreat as I was talking to other fundamental investors. They wanted to see more of a rounding top for them to really buy into this. And the fact that it was such a quick drop, they assume that we're just going to see a nice rebound because it's just a correction. But to me, that's alarming because there's all sorts of different types of tops in the stock market. And this one could be this blow off top. And I don't think it's straight down from here, but we'll see stocks basically consolidate. I think it'll be pretty symmetrical to what we saw as in this formation for the rally. Now we'll see stocks choppy again before we roll over and test lower. Maybe that's the 2,600 level. I would hope so. I'd hope that this acts as resistance, starts to find some choppiness through here before it actually rolls over one more time, if that is the case. But I also added this dotted line in red here because this is going to be the key uptrend resistance that basically to keep an eye on, because this is half of the move that we saw from the high to the low over the last 2 weeks. So that's going to be a critical level to watch, and just psychologically important for stocks to climb above that and close if we're going to see any sort of bullish momentum here. The next level to watch above that would be this gap lower around 3,260 for the S&P. You can see that there's a space on the chart that indicates a gap, so that could act as another area of resistance. And ultimately, what I'm looking for, and for me to turn bullish on this S&P 500 more so, and just go back to just buying stocks and being long and just holding on to these positions, this support level has to hold. If it doesn't, I can't turn bullish until they find a bottom and we can have a nice support. But then I need to see the S&P 500 break through this level, and ultimately set new highs before I really feel good about turning extremely bullish on the stock market. And I know that's it's too late, right? By the time they hit new highs, then we're going to go through another correction, another pullback. But I'm going to be trading this along the way. We're just going to be quicker, taking smaller profits, taking quicker and faster profits, and moving on to new trades, and also have more bearish positions on, so that way we can benefit from a pullback. And that's how we're going to get through this volatile market. But again, the key thing for me is going to be price going forward. And the main thing to watch is the trend. When it comes to stocks, the basic of any trend is looking at the highs and lows. So when we go back to the uptrend that we were in, making higher highs where the stocks peak at a higher point is great to see. That means that they're trending higher. So the higher highs is bullish. Lower lows is bearish. So we had this quick dip here. That was extremely bearish. That was tough to trade. But then once we got back above those lows, that was great to see. And then it continued to rip higher to set a new short-term high. So those are basically what I'll be watching going forward. And right now, after the quick pullback, it's very common to see the rebound. And I think we'll get back up around this level on the bounce higher whenever it comes, which I'm expecting over the next week or two, that we'll see a massive rebound in the stock market. But it's not going to get us back up to the all-time highs. Instead, it's going to be a lower high. And then I think we'll see stocks roll over and make a lower low. So whatever that ultimate bottoming point is, we're going to test that again in the next few weeks. And I think we go below it because of all the negative sentiment in the stock market, how the Fed reacted, how consumers are reacting to the coronavirus and the fears about being quarantined. This is just a stock market at this point that I think you have to be trading and at least be prepared for the worst possible case. And that's a 50% or more pullback from the highs, which we still would have 40% or so to drop even after the drop that we've seen. So we think we've gone through a massive correction so far. And if it just stays as a correction, a lot of this bullish stats that you see on pullbacks are based on just that. It's staying as a correction. But the second it goes down more than 20%, which could come as soon as this week at this pace, then people are really going to talk about being in the next bear market. But that doesn't mean that stocks go straight down. What we'll see is still a massive rally higher. In fact, when we had the massive run up on Monday, a lot of commentators were mentioning the fact that we see massive up days just like that. It was a historical rally. Some of the best days in the stock market to the upside occur in bear markets because the volatility is so high. So there's going to be buyers that come in. We're going to see massive runs higher. It's just not going to get us back to all-time highs, and it's not going to set the new higher high or a higher low that we would be looking for. Instead, we'll likely see lower lows, lower highs, and that's going to create the downtrend that the stock market could be forming right now. So that's something to pay close attention to. And that's why at this point, I honestly don't have a price target for the S&P 500 over the next 12 months. Because at the moment, I really think I could go either way. Honestly, I have no idea how bad it is out there for the coronavirus and how bad it's hurting the U.S. economy. The China stock market is actually holding up well. So there's some hope in how you look at how their stocks are reacting, because their economy has been shut down for weeks and they really just closed up everything to help contain this virus. In their economy, their stock market hasn't been beat up as bad as ours has. So there's a chance here that this is still overblown, and the impacts of it, even with people not traveling, would just be a short-term effect. But in hindsight, all of these effects start as short-term situations that just balloon into bigger problems for the economy. So we're going to continue to focus on our key levels. So these new trends on the chart, I'll be keeping a close eye on them. I'll just be keeping an eye on how the stock market's trading. But at this point, I'll be looking to add long positions once again. As long as the stock market is trading lower, the next major move I expect to see is the bounce higher. That's what we'll be looking for. So we'll be trying to come in and just get quick gains. I'm not expecting stocks to run all the way back up to the all-time highs, but just coming in, finding opportunities to cut losses when possible at a better level, and then benefiting from the rebound with some bullish positions. And then once we get a nice 5 or 10% maybe even bounce, as we go up by 5% increments, I'll be adding bearish trades to benefit from a pullback. So that's how I'm going to be trading this over the next several months. And then once we get a clear trend in the market, I'll come back through with an update on the S&P 500 to let you know my exact price target from the 12 months from that point. But for now, there's too much volatility for us to issue a specific price target. Now, I know that may not be what you wanted to hear today. I'm not coming out as this huge bullish, opportunistic attitude that I usually would be during pullbacks and corrections, but I still think there's a ton of money to be made. In fact, in all of my premium services, we have abilities to make money as stocks go down and to continue to benefit from these rebounds, like I mentioned on the price chart. So we're going to be extremely active in the coming weeks, taking advantage of the dips and the pops that we're going to see in the stock market amidst the volatility. But there is one service in particular where we look to generate income from the stock market, and it actually performs way better during corrections and during stock market crashes, because it's one of the only services where you actually generate bigger gains when stocks are going down. So it's an opportunity to come in, generate even more in income, and then your risk versus reward there, you really have a fine line. We're selling put options, so your risk is that you may end up owning the stock, and if it continues to fall, that's why you make sure it's a great stock that you want to own, but you're owning it at a discount and you're getting paid to do so. So even after stocks have crashed 15%, now you can come in, find stocks that you want to own at even another 5, maybe even 10% discount from where they're trading at today, and get paid to take that obligation instead of buying it today and then seeing the stock fall another 5 or 10% and wishing that you would have waited just another day or two. Instead, you can sell put options that gives you that cushion. It allows you to collect some premium along the way. So it's my number one strategy to look to implement for a conservative investor in this market environment. But even in my other two services, where we're looking at seasonality or trading options, there's incredible opportunities here in the short term to snag quick hit gains back and forth as the market goes along. So right below this video, I'll have links to each of my services for you to check them out. That way you can learn more, see which one fits you the best, and just see how you're going to continue to make money during this volatile market. Don't forget to click subscribe so that way you don't miss out on any of my weekly updates and these insights for my Bank It or Tank It videos. And follow me on Twitter at @ShoopGuru. Leave me a comment there. Let me know what stocks you want me to take a look at for next week. Just use the hashtags Bank It or Tank It, and then be sure to mention me, and I'll give you my quick take on those stocks and also look to feature them in the coming weeks. So Thanks for tuning in today. Let's keep our head up. I know it's volatile out there, but we're going to continue to make money and find opportunities in this market. So until next week, I'm Chad Shoop.